let's talk about another risk, which is what the central banks are doing across the world. Do you see that as a potential point of stress coming up with what the Japanese central bank is doing particularly, which might lead to China following with devaluation of its currency? But do you see that China following in its footsteps?
So I'd leave maybe that specific argument to my colleagues in Asia, but I would say that central bank policy in DM is very different from EM, or the emerging world is very differently positioned. And that is to say, DM policy has done two things with regards to the equity market. One, it's pushed rates down. That has allowed equity valuations to be quite full. And then in certain cases, Japan being one, you've seen currency weakness. And that's actually helped the equity market through the export channel, through higher earnings. The emerging world is not positioned like that, specifically so in terms of currency. We've seen strong depreciation across a number of emerging market currencies without an earnings response. And so why is that? Perhaps the things that they export have been sort of in oversupply, whether it's commodities. But secondly, the composition of the emerging corporate world is very different. It's a few markets like Korea and Taiwan have some of those export exposures, India to some extent in the IT services, but the broadest sectors are really SOEs, some telecoms, commodity companies, and banks. And so that response mechanism of whether it's QE or low rates or really the currency and the growth story is quite different in EM. And so I don't think that story would be as favorable if we saw continued EM currency weakness.
You mentioned banks. What's the way around the mess that we found ourselves in the banking space in India particularly, but also with reflection in other emerging markets?
So I would actually draw a little bit more of an optimistic tone, and I think that's going to sound, medium to longer term story. But when you look at the aggregate amount of credit that is spread in emerging markets, clearly there's been a very strong run over the past several years, and I think that's almost in every EM we look at. India is one of the few ones that has really started to recognize the NPL issue. And you can argue NPLs can be a bit of a lagging indicator, and you want to start buying risky assets ahead of the full recognition, but then we get into a debate of how bad it can possibly get. But I would say India is unique in that you've already started to see this cycle begin, which means, again, over the medium term, you're probably going to see India equities outperform before you see the pickup in the rest of EM.
What are your views on our RBI governor? There's a big debate raging on whether he should be allowed to go or stay. What are your thoughts?
Again, I'd leave the specifics to our covering Indian analysts. I would again say from the broader emerging market context, it has been clear that India has demonstrated quite forward-thinking central bank policy, and again, you can just argue that through the market response, which has been quite a good amount of stability in the rupee relative to other emerging market currencies, and so we do have a favorable view there.
Okay, so you spoke about a P band of around 10 to 12 times. Typically going at past cycles, do you see the piercing of this 12 number on the way up when you see a multi-year trend shaping up?
So you have seen higher multiples across EM, and so for those investors that think, okay, why couldn't we exceed those bounds? There's certainly the possibility, but we can also look within the valuation complex of EM, and what you find is a large amount of divergence, we should say. So the banking sector, especially in China, trades at a very low multiple, whereas the high-quality consumer names, some healthcare names, some of these sort of next-generation type stories trade at very high multiples. So ultimately, again, I would say for the overall pie evaluation to move upward, you need to solve some of the issues in those sort of stressed valuation sectors, which are largely the banks again.
Specifically on India, do you think our valuation currently of about 17 odd times, which seems like a fairly significant premium to the overall EM basket, would you say it's justified?
We do think it's justified in so much as you can look at relative interest rates, you can look at EM relative to the EM complex, and again, the growth differential, I think, does justify that premium currently. For the global investor who's looking to put money to work, again, they're not benchmarked, let's say, it is tough to enter an equity market at 17 or above sort of times earnings and think that the returns in an absolute sense will be very strong. So from that perspective, we don't see a great absolute upside to India. But again, it's the relative story that I think really jives with the benchmarked investor base.
You have a price target on the Indian market?
So our Nifty target is 8,500, which
You're
again,
almost there.
which isn't a whole lot of upside to be sure. But again, I think part of the view we have is that you might see emerging market assets broadly sell off as some of these risks in the second half manifest, and that would be a better entry point for to engage in India specifically.
What's your view on commodities from here on? Because we've had a very meaningful bounce in the commodity space as well.
Yeah, so we have a different view for some of the CapEx commodities versus OpEx commodities. That is to say, energy, some of the CapEx oil type commodities were more favorable. We do see some upside. Again, we've come off of a very low base, and so there might not be as much upside as we've already sort of realized. But things like copper, aluminum, we're a little bit less positive on. We think there's been sort of oversupply still in those areas. And again, where that will manifest across EM is we've been relatively more favorable on places like Russia, especially the currency, less so for the currencies in South Africa, Chile, etc.
How important is policy in the emerging market piece? Because, you know, the two countries which people seem to be talking about a lot now are India and Brazil, because there could be winds of change which started in India a couple of years back, and maybe Brazil, it's happening now. Between the two, relatively, if you had to pick a more attractive market or a story, what would it be?
So policy is, of course, paramount. Again, I would say it's very difficult to discount what we mean by policy or the word reform. Ultimately, there's a very clear relationship between risky assets, equities in particular, and growth. And so it depends on whether those policies are oriented to improve growth, not just in the short term, but really on a structural basis. And I think India has demonstrated a shift. I mean, you've seen it manifest in the growth numbers there. Brazil, there's a lot of optimism. We haven't yet seen what the plans are. We still don't know exactly how the political transition, if there even will be one, will necessarily pan out. So I think it's still premature to have a strong fundamental view on Brazil, but there certainly is potential there.
What are your favorite and least favorite EM equity spaces now?
So currently, relative to benchmark, we stick to quality, we stick to defensive names. India is at the top of that list. Mexico still is a strong contender. Korea and Taiwan have been relative outperformers versus the broader emerging market complex, so we would stick to those names. In terms of the least favorite ones, we've downgraded our view on China. Again, I think some of the growth views may be challenged in the second half there, as well as South Africa, Chile, some of the base metal sort of producers as well.
What are your expectations, Cesar, from the kind of global portfolio inflows we might see in emerging markets as an asset class over the next couple of years?
So I think that the flow story is still a good one, in so much as global investors are underweight emerging markets.
The positioning is still underweight?
A number of surveys would suggest that. Again, it depends on which surveys you look at. Someone has to own the stuff. But again, I would go back to, you know, we often associate flows with performance. We tend to think of performance as being a function of fundamentals, and the flows will follow the fundamentals. And so again, I'd go back to this idea that we have a strong cyclical headwind. I wouldn't get caught up too much in this long-term underperformance or this last several years and the outflow story. But it still is a challenge we need to overcome nonetheless, and the flows will come back then.
Cesar, it's been a pleasure. Thank you very much for your time today.
My pleasure. Thank you very much.